don't get so overly excited to try to eke out every dollar you can from your protection, from your savings, and from your growth.
The IUL, it's really like the El Camino. It's a really shitty car and a really shitty truck that tries to do a little bit of both jobs. Why would you risk losing everything?
Those human tendencies are why these policies fall apart to the tune of...
Hans, what's up, man? Here we are recording another episode, Remnant Finance. How you doing?
Yeah, doing really well. We're actually going to be, hopefully the next recording we do will be in Phoenix. We're going to a Kyle Fuller's event out there, and maybe try to record an episode from our Airbnb. So it'll be our first joint live episode. It'll be pretty cool. But yeah, otherwise we are just enjoying the October season. It's always my favorite time of the year. Weather doesn't change too much here in Coronado. We don't get the full effect. You kind of have to fake it, but it is fun. We just love like kind of the build up. I always have fond memories of Halloween and, kind of doing all this stuff there. And so looking forward to that. My in-laws get to town today. Actually, they're moving out for their 6-month stretch out west. So
cool.
That's always nice, but yeah.
Yeah, here in the somewhat northeast area of Pittsburgh, it was almost like it went straight from summer to like late fall. It was beautiful, sunny, dry, 70s, 80s, and then all of a sudden it was 30s at night, low 50s, rainy. There was almost even no normal color change like fall foliage. It just like happened overnight. Everything stayed green way longer than normal, and now it's all falling off. It was kind of like an ugly fall here compared to normal. But every year's different.
I heard New Hampshire kind of had a similar, like a shorter leaf season just because it was a little bit drier this year.
Yeah,
But we always, every holiday here, we have to fake it, like Christmas in sandals, Halloween in sandals, Thanksgiving, it's like you want to kind of like enjoy the holiday, but it's sunny and 70 still. You're still, sweating during the day or not, so I am looking forward to getting to New England.
The Christmas environment feels fake to me when I'm in the South or in a warm climate.
Yeah.
I don't know.
That's true. That's
You just get used to growing up somewhere where it's cold and snowy and everyone's bundled and it feels like what it's supposed to me. When I've been in Florida or somewhere like leading up to Christmas, it's just like this isn't normal.
Yeah.
But
Yeah.
I'm sure it's sort of the same in California. So let's talk a little bit about something going on here with Kyle Busch, and they have an IUL. So I have a Bobby Samuelson article. If you don't know him, he's kind of like one of the foremost experts in this space as far as writing across the spectrum of whole, like, what's up? It looks like you got something.
It's just Kyle Busch being the NASCAR driver, pretty high profile name. I mean, big name in NASCAR, but not a lot of people. I mean, a lot of people are not into NASCAR. So this is a kind of a celebrity news story, you might say, that has to do with the financial services industry, particularly life insurance, and is a kind of a great case study in why we will never ever recommend or sell you an IUL.
And there's not a lot of information on it. I was going to read about the NASCAR thing here in a second, but Bobby Samuelson, who wrote this, I'm only going to read this tiny little portion at the very top of the article because the rest of it goes into other details about it that are off subject, but he touches on the Kyle Busch stuff. Well, what's going on? This was written today. Today's 29th, right? No, today's the 30th. So this was written yesterday, October 29th, 2025. It says last night, two-time NASCAR Cup champion Kyle Busch and his wife Samantha Busch announced that they were suing Pacific Life over an $8.5 million loss in an indexed UL policy. The complaint, which is now public, makes it clear that the policy was not premium financed. That makes the situation all the more confusing. How do you lose $8.5 million on $10.5 million of premium in an indexed IUL policy? The only reasonable explanation is that, as this article discusses, and that's the part that's going to get deep, but the agent used all basic coverage with an increasing death benefit to maximize compensation that would also maximize coverage charges. And then it says, I'm waiting to learn more information and will likely write a subsequent article on the case. But it seems as though Pacific Life's unique blending structure may be at issue in this case. And he should note that just because a lawsuit says something doesn't mean it's true. That's for the courts to decide. But one of the basic points, and that's why I don't want to like go deep into this article because it's going to talk about Pacific Life in general. But one of the problems with the IU policies is they have so many bells and whistles and so many levers that can be pulled, and the way that they're structured does mean that the agent has a massive burden to make sure that these are built right. And the truth is, like, I would never sell one, I would never buy one, but they can work. The problem is, will they work? And who's the agent writing it? How is it going to be maintained? There's a lot of risk involved in these the reasons these could work, and almost all the time don't work though. And part of it is just what it says there. The agent used he built a specific design, basic coverage with an increasing death benefit to maximize his compensation. Um, and it would also maximize coverage charges. So they're not built-in charges that are just inherent to the structure of the policy and what we do with whole life insurance, where that's all predetermined, regardless of what we do. We could change the ratios and some of the different types of premium, like we've talked about with things like with the add-on of a term rider that will change a little bit of that, but it's all laid out up front. Like, you know exactly what it's going to cost, you know exactly what the fees are. It's all predetermined. Nothing can change within the policy. So this is just I'm actually, it's probably good this happened, because when somebody has a $100,000 death benefit, standard middle America, nobody will ever hear about it. Their policy will collapse, lose all the value. They get hurt. Agent moves on, company moves on, industry moves on. They complain to their friends and it's over. But when you're talking about somebody that's young, relatively young, he's probably, I don't know, 40. I have no idea how old he is.
I know. I'm not a NASCAR
Yeah.
guy.
He's neither am I, but he's a relatively young man
He
losing
looks 40.
paying 10.5 million in premium, losing 8.5 million of that already, and having the capacity to sue on a national case. It's actually huge because it brings to light that there's massive problems, not only in this industry, in this product.
Yeah, and it's unfortunate, obviously, for him and his family. It's unfortunate for the industry that we feel very strongly about, and we love the product and the asset that we work with because it is such a powerful tool. But what we want to what we want to convey today is that there is a place for the protection and savings, and those things should be very well buttoned up, and we should not be excited, and we should not be, you know, rushing to try to maximize every square inch of our protection and savings castle. Like, you can do that on the growth side, but even then we want to tamp down expectations because we don't know the future, so we need to inject as much certainty as possible. So when you're having these IULs, the problem is they're taking what people like about a whole life policy, and then they're picking a few things that they don't like and say, well, if we just remove these things, we can add some levers here, we can pull some strings here, and we can kind of make this an investment product that has insurance, or an insurance product that has investments. You're blurring the lines, and 95% of these, making up a number, but I'm repeating the number that many people that sell IULs have stated, the people that actually understand the risks involved, will say that if your agent's not following up with you every year, not monitoring you, not closely dialed into the status of your policy and how you're paying the premium, because you have all these options, you're putting people who have a tendency towards the path of least resistance. They're going to take the path of least resistance. And if they do with this product, it is going to collapse in most situations. And so we want
Well,
to kind of put
and
some water on the fire of like, don't get so overly excited, over eager to try to eke out every dollar you can from your protection, from your savings, and from your growth.
yeah, and within these products themselves, like, they're built and the illustrations are so incredible because they don't talk about all the moving parts and all the potentialities of what can happen. So it's sort of like just using, we always rail on the calculators that a lot of typical financial planning uses, where it just shows this perfect line that goes up forever, earning 10% in the market, no ups, no down turns in the market, no fees, none of that baked in, and it just looks glorious. And the IULs do the same thing because of the basic structure of them. I do want to talk a little bit about, like, if we're going to not rail on IULs, but talk about it, like why they're not good, before we even go into our basic idea. But like how it actually works is they'll tie it to some kind of, upside and downside based on how that thing is, based on whatever the performance is being tied to in the index universal life. So there's a floor that says no matter how much the index falls that it's tied to, you can't lose beyond that. The floor is usually 0%. That's kind of typical. So it says like, hey, if the market or the index this is tied to goes negative 20, you won't have the gains, but you can't lose any money. Your stuff stops at 0. And then it gives an upside potential, which they call the cap. And so in exchange for that protection, though, you will have a cap of and at some points they've been as high as 14 and 16%, but let's say it's 10%. That's kind of like the common number now. The cap is the most you can make. So if the market, like it is right now in 2025, I don't know what it is like 20 some percent this year, say the S&P index. If it does that great, you're capped at 10%. And that's the trade-off for having a floor and not being able to lose. But the way these are baked in is it's a monthly mortality charge based on the net amount at risk. So as soon as you have that 0%, if you actually hit the floor, it's still charging you from the cash value you have additional beyond your minimum premium, which is usually really low. So it starts to eat away at the cash value to correct the price of the policy. And so over time, if that happens enough, it can get really bad to the point where they cannibalize themselves. But the other problem with that upside potential, that cap, is it's not a guarantee. Like we talk about in our whole life insurance, things are guaranteed, everything but the dividend. So it has a guaranteed actuarial increase no matter what happens. There's a percentage rate that's based on, but then inside the policy, it's going to do exactly this regardless of what you paid. It's tied to that percentage rate, but it is a guaranteed increase. Well, these caps can be dropped at any time, and sometimes they are in 2 to 3 years. Somebody will open a policy, the companies will create a new product and lower the cap on the old product. And the cap will go down to say 6%, 4%, sometimes to the minimum guarantee. They do have a minimum guarantee, but it's 2 and 3%. You still have that floor. So all those mortality costs that are baked in just keep eating away at the policy, and you can no longer reach that 10% you were promised when you bought it. And the third part of these is some of them have something like a multiplier effect inside. It's called a participation rate. And you'll see that language in the illustrations. It's like a multiplier effect. So they'll like, it might be 150%. So say the market does 4%, they'll credit the client with 6%. But the trade-off with that is now you're having an even lower cap rate. So everywhere is some sort of trade. There's no deals in insurance, including these IULs. So if you get that participation rate, you also probably have some pretty large fees that are baked in and hard to find, but you're also potentially having a lower cap rate, the most you can earn. So and they will perform phenomenally in the early years because they might show it at 8% with a 12% cap. And if the market's crushing, it looks like your IUL is doing great. But when things change, and it seems like they always do, and without that agent who doesn't have the secret sauce like this, potentially, I don't want to accuse the agent of something, but with this Kyle Busch thing, like the speculation is that he wrote this policy to benefit himself the most for the most compensation. So if you don't have an agent who's one, going to be a good moral fiber, and two, looking out for your best interest, and three, really understands this and knows how to make the changes appropriate, you can find yourself in a bad place pretty quickly. Or
and
definitely.
four continues to follow up. Like this requires constant maintenance. Our clients with the whole life policy, if they're paying their premium and they understand it, and our goal as an education company is for them to understand this asset better than any other asset they have. We want them to know how these premium mechanics work, how the policy mechanics work. They don't need us. We are here for them. We continue to provide policy service and help and advice, but they don't need us because this policy works on its own, regardless of our follow-up. As long as they're paying their premium, all the rights they've learned, and we talked about the premium mechanics, how the PUA works, all that stuff, that's just all working, right? There's no questions about it. They don't need us, but we are here for them. With an IUL, you need your agent to continuously provide, and I have yet to meet one that does that continuous oversight. The first exposure I had to IBC was from a buddy whose brother had an IBC policy, and they bought it from their aunt. He bought it from their aunt, and the friend who was my buddy didn't end up getting it because he was a little skeptical. And I know now, like, that person who sold the IUL doesn't understand these policy mechanics, and I'm certain is not following up every year. It's cheap in the beginning, and it's illustrated at the beginning. Let's think about term, right? Term is cheaper. Buy term, invest the difference. Well, if you buy a 30-year term policy, you're going to have a fixed expense for 30 years. the state law requires that you give an additional 10 years beyond that, where they have the right to extend that coverage, but not at the fixed rate anymore. So if you see an illustration, you'll see you have a 30-year term rider on this policy, or if you just have a term policy, you have a 30-year fixed rate for this term. We're required to offer you coverage for an additional 10 years beyond, whether it's a 10-year or a 30-year. We're required to offer you another 10 years, but you're no longer getting the fixed rate. You're getting the quote, the market rate, i.e. the rate you would earn every year. So if you're 40 and you get a 30-year term, at 70, they'll say, all right, your term's up, but you do have the right to continue for another decade, but you'll pay the price for 1 year of this amount of death benefit. You'll pay that for 1 year. And that number is off the charts. By the time you're turning 80, that number is prohibitively expensive. By the time you're 90, it's going to be almost as much as the death benefit to pay for the 1 year premium. So like nobody does term policies in their 70s and 80s. Nobody does 1 year term. But what you signed up for when you got that IUL at 30 or 40 is each year that scale is set to the year you are. So at 30, to get a 1 year term policy as a 30-year-old, pennies, right? $1 million policy, it's like $12 a month or something. It's crazy, right? So that's what you're looking at on the illustration. The illustration is going to know, it's not going to know exactly because they can change those mortality charges, unlike in your whole life, but they can change those mortality charges. But the illustration will reflect the fact that insurance gets more expensive over time. But the illustration also assumes you continue to make that premium. You have all these levers to pull. Now I'm going to give a quick story here. Clients will figure out the amount of premium they want to pay annually. Let's say it's $50,000, $30,000, whatever it is. In this example, it was $100,000 that this client wanted to pay. But the PUA is optional, right? We have the option to not pay it. And so he said, well, hey, I want to pay monthly. So let's just chop this down monthly. Okay, cool. We've got our amount of premium you want to pay divided by 12. Well, hey, I'd rather just pay the base because that's a required portion. Let's auto draft the base. In this case, was about $2,000 a month, 24,000 in base, about 75-ish in PUA. Let's just auto draft the base and I'll pay the PUA when I can. This is an ongoing situation. 3 months later, things change in his personal life. Things change with an ex. Now she's asking for more, whatever the situation is. That without getting into details. Basically, it's like, what are my options here? How do I what can I do with my cash value? I'm like, well, you haven't put a single dollar of PUA into this policy. You've only paid the base premium. You wanted the flexibility, and the flexibility was good, but you opted to not pay. So now you have no cash value because you're 3 months into a base premium. Like mechanics, we talked about all of this. You don't have cash value. So your options right now with what you can do with the cash value is nothing. And so very likely that policy is going to lapse because he now has to put that money elsewhere, but there's no savings component built in. That's an example of getting super hyped up and excited and wanting to bite off more than you can chew. And this was a case where he was very certain he was going to be putting large premium into this policies, but wanted to trim it down to just the required amount. So that's what we did. But if you have that out, if you have that path of least resistance, Parkinson's law, all of these human tendencies, we all understand them. If you have the ability to not pay, you might not pay. And so let's say you sign up at 40, the market's soaring like it is right now. 1 year of insurance for you is nothing. So this policy looks really, really good. You build up, you get the market return. Say you have a 13% cap, you get your 13% on the separate account that grows. It's not your cash value, it's a separate account. That number goes up. Then you get a letter from the company. You're going to get a letter that says, hey, you don't have to pay premium this year because your policy can support itself. How many people, if you get a letter saying you don't have to pay premium and this policy can just chug along without it, how many people are going to take that option? A lot of people do. If you do that, a lot of people do. Now, fast forward 40 years, the reason why these policies all collapse and only really pay out if you die young is because when you're 80, if you've taken over decades, if you've taken that path of least resistance and said, oh, I don't have to pay my premium this year. The policy can pay my premium itself. Oh, it's awesome. Let me put that money elsewhere. Well, now you're underfunding it. So you're moving off of the assumptions made in the initial illustration. But now you're 75, you're 70, going on 76. Now they say, hey, you used to have a tiny little cost of insurance, but now it's $16,000 just for your insurance component. And you haven't been making those premium payments. So there's nothing to fill that, there's nothing to move over. So you now owe additional money on top of your required premium. And so these human tendencies are why these policies fall apart to the tune of 90+% from everything I've read. That's conservative. If you're not tracking it, if you're not, as an agent, making sure, if you own one of these, if your agent's not calling every year and say, like, how much did you actually fund this year? Let's review our actual cost of mortality. Let's see what these margins are. If that's not happening, your policy is going to collapse down the road.
Yeah, and these are based on the net amount at risk. So where you have that minimum premium, you can put more in, and there's a certain death benefit that is, so-called promised in these IULs. Based on the gap between those is the net amount of risk, and that's what your charges are going to be on. So like since 1926, the 100 years almost exactly, the market has gone down 2 years in a row, 8 separate times. So if that happens, even if you keep the 10-year cap rate in an IUL, it takes 5 years of absolute maximum performance just to catch up before the mortality and expenses. But while that's happening, the underperformance of those 2 years where you got zero addition, where it did nothing for you, that creates a higher mortality charge because your net amount at risk, since it didn't grow, it didn't fill that gap between how much money there is and what the death benefit is. So that actually increases the mortality charges. And so it's costing you more on less money when that happens. And those higher charges, they make catching up like almost impossible. It makes it more challenging, not impossible. If you just kept going and maxing out the cap rate, if the company doesn't lower it, you might catch up eventually. But there's just so many moving parts in these. And really the bottom line is when we take out whole life insurance or even term life insurance, you're transferring the risk to the insurance company. You're paying a particular amount of dollars that transfers all the risk of your death to the insurance company. When you do an IUL, because they put all these moving parts, they tie it to an index. It's an annually changing premium based on those mortality charges, based on how the performance of the thing, based on the performance of the policy. They are transferring the risk back to you. So
Mm-hmm.
what's the point of it? All insurance, not even life insurance, but what is the point of any insurance policy you could possibly ever take out?
It's risk pooling and risk sharing, spreading the risk to
It's not even, it's
to
just
a
to
central, yeah,
I'm going to pay you,
transfer risk. Yeah.
put the risk on you, man. Like if I get into a car accident, you're going to pay to fix the car. If if I get a hailstorm that ruins my roof, you're going to pay to fix the roof. In theory, I mean, we see how that's going for a lot of people, but you know, that's the whole point of insurance. But IULs stand there and they go, you know what? We're going to put some of this right back on you and your basic behavior, and we're even going to tell you can change your behavior throughout by not having to pay the premium. So we're allowing your behavior to change. We're putting the risk right back on the human being, which I think is the opposite of what should ever be done. It's one of the reasons I would never, ever, ever sell one of these. But all that ties back to our original framework that you mentioned at the very beginning: the protection, the savings, and the growth of your money and your capital.
We don't want, like, we want to build a firewall between our protection and our savings. We want to build a firewall from anywhere where there's risk. I don't want any risk in that. Like the fact that you could expose your family to that level of risk in your protection asset because you wanted to get more cash value, it's like that is intuitively against our philosophy. So just even if these policies didn't have such an astronomical failure rate once people get into their older years, the reason there's IULs is because there were VULs, and the VULs are mostly collapsed. And the reason there were VULs is because ULs, and those mostly collapsed. Like what we have a tendency as, and we see it in ourselves. You have certainly, if you're listening to this podcast, seen how excited we are about low stress options, but we want to tamp down that a little bit and reset ourselves to, here's a great tool. Let's not just push it to the boundaries and try to optimize every single, like, let's do what works and let's do what's simple. And so our natural tendency, especially like our group, being a lot like mostly young military pilots. I mean, I'm still going to call myself young. You're a little over the hill there, but um,
A little bit. I'm
like
getting
our age, like in the our general audience or general client base, guys are like, let's push it, and I get that. And so we get this framework. This works. This Troy's framework. We're trying to target this 1% a week. That's off the charts, right? You're beating every hedge fund there. It's phenomenal. Like nobody needs to improve upon that because inherently beyond that envelope, there's risk. And as crazy as it sounds, if you understand that framework, targeting that 1% a week is being very conservative when you see the premiums that you could be getting. But with more premiums comes more risk. And so we're actually doing this in a very low risk, low stress way, which sounds crazy in the old way of thinking, in the financial planner model of thinking. No way you can make that without it being just a huge Ponzi scheme, right? Well, when you understand the framework, it makes sense. But of course, a bunch of us being a bunch of military dudes, like, okay, here, this is cool, but how can I do better? And our group chat is case study after case study of like, hey, I could get 1% for this, but look at this. If I just take a little bit more risk, I can double my return, right? And then a week later, well, shit, that didn't, we're still going to get out of this position. We're going to unwind this eventually. But it's like we keep getting slapped around with our own validation of just do what's simple and what works, because this is vetted, this has been tested. And so we don't need to try to expand this. That's how I feel the IUL industry came about as a result of people like, hey, this works. Look, policy loans. Look at these mechanics. Look at this guaranteed cash value growth. Look at this tax-free death benefit, the tax-free dividends. Hey, this is a great thing. How can we push the boundaries on this? How can we make this more appealing to the person chasing returns? And that's why we have this bastardization of a product that just is a Frankenstein that blends all of these elements of a strategy together and achieves none of them efficiently. It's not your best investment vehicle. It's not your best performing insurance vehicle. And it's not a great savings vehicle. It's like we've got three separate buckets here, three separate strategies. You want to combine them into one thing and then just poke it full of holes. Like it's unnecessarily pushing beyond the risk, like pushing beyond the envelope. Pilots will understand that the power curve, like we're going beyond the power curve on these things, and we're seeing failure when we do that. It's like, let's just stick with what works.
Yeah, like I've said before, the IUL, it's really like the El Camino. Like it's a really shitty car and a really shitty truck that tries to do a little bit of both jobs. And I don't know
Yeah.
why anybody outside of nostalgia would ever want one of them. It doesn't do either job well. And an IUL doesn't do that either. It doesn't provide really great protection. It can in the short term. I mean, if you die really young, which you're not planning on, and it doesn't really create a great investment vehicle, especially because that hoax of like the downside protection. Um,
Yeah.
and when you compare it to whole life, it's like whole life is the only product out there that has true downside protection, unlimited upside potential, and guaranteed increases every year. It can't get crushed by the inherent nature of what the policy is. So we stay away from them. I mean, we could go probably a lot more in depth on that, but man, it's just like back to the basics over and over and over. Protect, save, grow. Like protect and
Mm-hmm.
save is the point of this. Like, why would you risk losing everything for a slightly better illustration to potentially eke out slightly higher cash value? And there's crazy people out there saying you can do IBC because it has more cash value early, the way they're illustrated with an IUL. But as soon as you start accessing that policy, you're changing the net amount at risk, and you're changing those internal mortality charges in an IUL, which you're not doing in whole life. So I would never use one. I would never practice IBC with an IUL. Everything changes as soon as you start accessing those funds. And it's like, why take the risk just for a little bit more cash when I know that I can do something guaranteed? It doesn't make sense.
I've had two similar conversations recently with people that are not that don't understand. So one, I want to make the distinction: IUL for IBC, the way that the way that makes sense to do it, the way that's a proven way of practicing what we were trying to implement. It doesn't work. It's not philosophically aligned, and mechanically, it's too weak of a vehicle, we believe, to use it. But so anyone who's like thinking that these are the same worlds, it's not. We would never touch those. But I've had two similar conversations recently where it's like, hey, I'm pretty skeptical of what you guys do. And I've found personally that it's labeled IBC, that it has a branding, that it has an acronym even. It's like once it becomes a strategy, once it becomes a philosophy, then you have to evaluate the branding. But you can strip away the letters IBC. You can strip away any kind of branding which you want. What it is a contract, and it's the usage of a contract. And so I had to kind of do that where I was like, all right, this doesn't seem legit to me. I trim back the label, trim back all of everything. You could never hear the term IBC and still do this, right? It's a whole life insurance contract. It's got a 200-year plus track record. The contract either performs as written or it doesn't. And centuries now of case study have proven out that the contract works as written, right? So it's not about does this contract work? We can get there, right? It works. It works as advertised. It's a black and white contract. Does it work? Does it not? And it does work objectively. There's no argument there. Then the question is, does it make sense for you within your strategy? And at that point, if someone can understand, okay, I don't quite get IBC, I don't like this branding of it, but okay, I believe you. I get that the contract works because it's a legal contract. Okay, cool. Well, does it make sense for me? And that's where people don't understand it. That's where people get into their misunderstanding put out by, financial checkers, grandmaster Dave Ramsey and other like financial influencer who trash it without understanding the product, or in my mind, they understand it, they intentionally misrepresent it. But regardless, most people that have strong feelings against it come to the table with a lot of incorrect assumptions. And I've yet to meet someone with strong objections who can competently walk through the mechanics of a policy. And so then we have to start with okay, the contract works. Does it make sense for you? And do you actually understand it? And the problem with a thing like an IUL, like with this news story, is that it contributes to the body of knowledge of what we're trying to do in a negative way, when in reality, it has no overlap at all with what we're trying to do. It has no bearing on how your policy will work if you work with us. And so it's unfortunate. I mean, I think it's a net positive that the IUL product is getting this attention, because it's hopefully can prevent someone from making the same mistakes of assuming they're going to get one thing, and in reality getting this leaky bucket that might work if they patch all the holes quick enough, but probably won't. Statistically, to the tune of 90+% won't work. So it's unfortunate that we have to have a story like this, but this does contribute to the general misunderstanding of what we do, and it's unfortunate. You hate to see it, but hopefully people can understand that is not at all what IBC is, or if you want to strip away IBC, what the whole life contract is. There's really no overlap between the two products, and so you can evaluate them completely independently. They have the same name of permanent insurance, and that's where the similarities
I was just going to say, that's it. They're both just categorized under permanent life insurance. But yeah, and the internal rates of returns on the death benefits of an IUL will continuously decrease, and on whole life insurance will continuously increase, especially on a dividend paying whole life insurance policy. So yeah, there's nothing. And so I just, to reiterate, protect, save, grow, like in the protection component, you have to protect from any of those unmitigated disasters in your life that can kill the wealth curve, whether that be disability, death, catastrophe in your life, a flood, a lawsuit, it doesn't matter, divorce. Like any one of those can kill your wealth. So if you don't have proper protection, and that's the key, what is proper protection? What is proper protection on your car, on your house, on the possibility of disability, on your death, whole life insurance and term? What other protections am I missing there? There's a ton of them that you could think about.
liability.
Yeah, having your things in a trust, liability as an umbrella policy, for example. Just having a standard savings habit is so important. So even before you worry about growing your money, like have a pool of capital. We keep that pool of capital in the most optimized environment we believe which is whole life insurance. Having access to capital in the event of an emergency, in the event of an opportunity, is so important. You don't want to skip the savings component, because it also builds a habit that is guaranteed to succeed. If I could convince every single 18-year-old out there who earns an early paycheck, or teenager, to save 20% of their money, they will be wealthy. It's a guarantee. It might be a long road if they do it extremely conservatively, but it's a guarantee. They're going to become wealthy because they've established a habit of not spending everything they have. So savings is the next component, and then focus on this growth. Well, trying to mix them all up in one single thing is just always going to be stupid. Like compartmentalize those as much as you can. For us, fortunately, whole life insurance kind of does 2 in 1, but it doesn't also contribute to the growth portion of our life, what we want to do in investments, and how we want to make our money multiply fast. Keep that separate. And I believe even follow the same basic idea. Like, how can we think long term with that? Like, it's easy. Like you were talking about LST before, the options trading. Like, it's really easy to want to be like, I should sell my car, I should sell this, how much more money can I put in? Where can I leverage the most amount of money? What all can I do to make this happen in like 1 year? And it's just like, I mean, with a pretty modest amount, if you follow the basic framework and everything goes pretty well, and there is some risk there, you can have a 7-figure account in a shorter period of time than anything else I've ever seen. So like not losing sight of the think long term is so important. Like we're young still. We still have 40, 50 years of life in front of us probably. And if you can
Mhm.
reach that 7-figure point where then the multiplicative effect is just so fast. It's almost like that first 100,000 is the hardest thing to do. And then that turns into 1 million fast. That turns into 10 million even faster than the first million. It's like if you can do that in 5 to 10 years, you've got nothing to sweat. No reason to put your money and your life and your family at risk.
Yeah, for sure. I'm gonna make one first one of that one quick final point, one final thought on IUL is just if people are still like considering both or not quite sure. Just remember when we talk about a lot of the power of whole life, you're not getting dividends with an IUL, and that's sort of the foam in the company portfolio of like my mortality charge on my whole life policy, my guaranteed cash value growth. Those things are all set in stone. Those don't get to give way if there are, you know, if if,
There
if
is no
things
if.
start getting, yeah, I mean,
Yeah.
when eventually things start tightening up, like the economy constricts,
Yep.
right? These companies are better positioned to manage a constricting economy, a recession, anything like that, better than anyone else because they have such a deep liquidity pool and decades of bonds that they can pull on. And so it's like if the bond rates go down right now, it doesn't matter if you're pulling 12% coupon bonds from the 90s because you have such a ladder portfolio. Like they can weather these storms, but the whole nature of economics is expansion and contraction. When contractions happen, where they can dip into and where they can shed benefits from is these policies where they wrote into the contract, hey, we can change the caps here. We can change the mortality expenses. We can change the policy expenses. Like, yeah, you have all these levers, but so do we. Every lever that you can pull is a lever that we gave you to pull, but we can pull another lever. And so if you talk to people at the companies, like your whole life policy, like we're set, we're good. We're gonna my contract's gonna perform as written, guaranteed. You don't have that same assurance because you are kind of the foam on top of the beer. If something's going to go, like yours is going to be the first to go. But on the trading note, there, it's like if we're continuously having to reset our expectations. The more we learn, we want to take in new data, change our prior assumptions, right, and be willing to adjust. Like that's growing and intellectually maturing, right? If a new thing comes in, I want to evaluate it. If someone tells me, here's what you can make, and if I stress test this and I validate it, then okay, now for me, my floor of what capital can be doing is a lot higher than it used to be. At a minimum, you should be making a high yield savings account. But before 2 years ago, if you had showed me an investment that was, growing at 10% a year, and I could look at it and I could see this growth chart, I'd be very satisfied with that. Right. Looking at if I get a guaranteed compounding rate of return, which of course you can't get the guaranteed compounding in the market. You don't get compounding interest in the market in general just by buying index funds, for instance. That's not interest. But if I could get a guaranteed return, if someone offered me, say, hey, here's a 15% rate of return on a guaranteed hard money loan, I would be through the roof excited about that. Now we have this new floor. So I can't, like, I don't want to, okay, now I have this great new floor of what my capital can do. I'm not going to push beyond that just to try to get more when I was happy before with a quarter of that performance. And so just be okay with what works. And we find ourselves so excited about this, and we want to, in the same vein of like, don't turn your whole life into an IUL disaster. We have this phenomenal tool. We have this great collection of growth assets that we are using ourselves, introducing our clients to, getting in touch with the right people to set these things up. This one we are very excited about right now, but let's pour a little water on the fire. Let's bring it down a little bit so that we don't just rush into low stress trading and make the IUL version where we then let it collapse, right? Like, let's take it slow. And like Brian said, let's give ourselves more time because we're loving this couple months worth of consistently beating our 1% per week target. It's looking phenomenal. Going to keep doing it, and we'll keep updating on our progress. But I'm not going to go like, I don't know. We don't own this house here in Coronado, but like, you're not going to go take out a second mortgage to go trade in this because we need to prove it out to ourselves. And if we are in fact making 1% a week, We do not need to improve upon that, right? I'm not going to push that boundary at all. So let's just collectively, for our group, for our audience, we're so excited about this, but let's just remember not to IUL this thing and make it an abortion of a product,
Yeah. And final thing I have to say on IULs is if you are opposed because you've been propagandized about whole life forever and that it's the worst place to keep money, if you're listening to this and you're thinking, I want to do an IUL, my suggestion to you will be buy term and invest the difference, because at least you are actually going to have your money when the term expires, of some sort of investment, whether it was a poor or good one. You're not going to lose it all. Or with an IUL, I believe you'll probably lose it all. Like he said, 90-some% of the time. So that's the one time that I would actually recommend buy term and invest the difference along that mantra, is if you are just like stone cold, feet dug in, cannot ever have your mind change that whole life is a good product, but somebody has you thinking an IUL is, go buy term and invest the difference. You'll be better off.
Yeah.
And, yeah. No, it's hard for me to say that.
That's nothing I thought I'd ever hear you say, but I think you're right. I would definitely rather do that.
If those are your two choices, do that.
Yeah. Yep. Yeah, that's solid. Don't push the envelope. Do what works. Be conservative at the end of the day. Like, we're thinking long term. I heard today, what is it? Think in years, but measure in weeks. And I think that's a phenomenal way to look at this. I'm going to keep measuring my returns on this. I'm going to keep adjusting to make sure that I can maintain this. I'm going to set my expectations and plan off a very conservative assumption of what I'm currently doing. I'm going to keep measuring in weeks, but I'm thinking in years. If X doesn't pan out as I believed it would, how will I, what is the logical conclusion of how I'm currently treating it? If low stress trading were to not pan out in 5 years, what would be the result of over leveraging my life insurance policies, of selling assets, of all these things we're doing? What would be the result? And can you live with that? Keep it simple, keep it conservative. We're continuously reevaluating, and so far only getting more validation as we get more experience, which is the way we want to go. But let's not get so hasty. Let's not IUL this thing. That's all I got.
Yeah. And if it seems too good to be true, dig a little deeper.
Yeah.
Don't run. Dig deeper. Find out. Try to poke holes in it. Yep. Anyway, man, that's all I got.
Cool. Well, I'll see you next week.
Yep. We'd appreciate you guys if you'd like, subscribe, share these episodes with any of your loved ones, any of your friends in your network, and help some other people learn how to build wealth in time and think long range.
Yep. All right, y'all. Cheers.
See you. Thanks for listening to Remnant Finance. If you found any value at all in this episode, please subscribe, leave a review, and share it with a friend.
Remember, true financial freedom comes from taking control of your personal economy and breaking free from the status quo. So stop being a passenger in your family's financial future.
Boldly take back control of your wealth. Until next time,
this is Brian and Hans signing off.